How's it going, everyone? It's Sam. Today I want to talk to you about why my business has a massive problem, and it's not what you think. Now, I'm going to put that towards the end of the video. I want to cover some of the top news to start off the video, though, and talk about the market. So, if you don't mind hitting the like button and subscribe button, I appreciate that. You can see that the market is looking like it's going down a bit today. On the last 24 hours, down about 2.2%. That was about what the NASDAQ was down as well, with a lot of large investors kind of positioning ahead of that CPI reading in just a few days. That's on Wednesday. And then, as I said, we do have bank earnings after that. So a lot of people are trying to figure out what they're going to do ahead of that. Now, we do have a couple pieces of news. Chinese banks have frozen customer accounts in the city of, I'm not going to say that because I will just not get it right. I won't be able to pronounce it, leading to civil unrest. Bitcoin can't be confiscated. So this is a good point. This is one of the things that people love so much about Bitcoin. It's one of the only things that you actually own. It's one of the only pieces of property, right? There's so many things that can be confiscated from you, whether it's gold or cash or your bank account or even your property, right? If you don't pay property taxes here in the US, that gets taken away. So Bitcoin is one of the only things that everything is stored right up here, and you can get access to your crypto. It's on the blockchain, but it's inaccessible to so many other people. So that is a great selling point of crypto. Then also we have Grayscale, the legal officer, saying that the Bitcoin ETF litigation could take 2 years. Now, a lot of people are hoping this gets approved by the end of the year or early next year. I think this could take a while, but I think regulation here in the US is really what they're searching for before they approve the Bitcoin ETF. So I wouldn't be surprised if it didn't take 2 years, but if we actually had one approved after some more regulation came in. And I think what's happened over the last couple months has been really a good thing for at least the politicians to try to push regulation through with Three Arrows Capital, with Luna, with the collapse of a lot of different exchanges. Fact is that now we need more regulation than ever. At least that's what a lot of people think, and a lot of people are probably open to it because a lot of people got burned on some of these different exchanges. And then the last thing I want to talk about before the problem with my business, but it's not really a problem. I think it's actually something that I need to talk more about, though. KPMG to audit new pound-backed stablecoin GBPT. So this is a really interesting story, and it's not really much more than exactly what they said here, but their new British pound stablecoin is going to be audited by KPMG, which is, I think, another reason that it was so smart for KPMG to get into cryptocurrency and to start buying is because they can be an auditor, which makes sense, right? They're a large accounting firm. They should be doing this anyways. But we have a couple different companies that audit cryptocurrencies already. But if we can get something as trustworthy as KPMG or some of these other top 4 accounting firms to start auditing these different kinds of cryptocurrencies, I think it will place a lot more trust, and I think it will be a lot safer. They're smarter than some no-name company that's audited a crypto before. So I think this is a good step in the right direction, and hopefully can continue to grow KPMG's crypto business as well and keep on with the adoption of cryptocurrency. And then the last thing I want to talk about is my business. Now, the reason I'm saying that I have a problem with my business isn't because of the business itself. It's that a lot of different investors on YouTube try to get clicks, right? We try to talk about how we're selling everything or how we're buying everything or how we are buying a huge amount of this stock. And something that I've focused on a lot more this year, which actually has done really well for me, is dollar cost averaging. And I say it a little bit tongue in cheek that that's a problem of the business, but really it's just that doesn't make for great content. And I talk about the things I'm buying, and actually I have a video here in the next few days talking about how I'm buying Bitcoin. But the fact is, I am largely just dollar cost averaging. Like, that is the majority of what I'm doing. I do have some cash sitting on the sidelines just in case crypto falls even further. I think crypto is slightly different than an S&P 500 index fund, but this article is fantastic, and I've seen variations of it before, whether it's like 3 different sisters investing, and one buys at the same time every single month, one waits for the dips, and then one buys at the worst time. They're similar articles, but this one triggered a lot of people last time I showed it just because of the phrasing of the title. Even God couldn't beat dollar cost averaging, but the information in here is really solid. So let's not try to comment in the comment section about how this is insane and stuff like that. What they're trying to get at is You could either invest $100 per month for all 40 years, or you could buy the dip, and you could buy the dip at the perfect time in between two all-time highs. So you would buy it at the lowest amount. The thing is, when you run this scenario, you would think that the buy the dip would always be right because they're buying at the exact bottom between two peaks. However, that actually underperforms dollar cost averaging 70% of the time. So I really believe in dollar cost averaging. Now, this is again an index fund versus specific stocks, and there are specific times where buying the dip is actually a lot better. But I'll go through it a little bit more why I'm dollar cost averaging. But what I'm saying here is that doesn't make for great YouTube content, which is kind of just something that I'm okay with. A lot of other people try to play it up that they're buying a ton of this new stock or crypto, and I just don't think this is a great time for that. In a bull market, I think that's a great time, or even if we start to return and you think that one altcoin is going to do really well, I'll probably make videos like that too. But the majority, like I said, the majority of my money is just going to dollar cost averaging now. So why is it that buying the dip does not beat dollar cost averaging? Well, you can see some of these all-time highs. You can see where you would buy the dip. This is giving a little bit more clarity to where you're actually talking about buying the dip. So basically, in between any two peaks where there's an actual drop, right, we can see that you would buy the dip. So you would store up all your money up until here, then you would buy, and then you would continue doing that. Let's say we go over here, you would buy right here, and then you'd save your money, your $100 a month. You would save, then buy right down here at the perfect time. Then you'd save, then buy right here, save, buy right there. And in some scenarios, this actually works out to be better. Usually it's when we have a dramatic drop, or we go sideways or up and down for a significant amount of time. So this shows you your invested amount from that last scenario. You could buy. You have a lot of cash, keep on getting more and more cash. Then you buy the perfect time, and then it goes up. You buy it at the perfect time again. The problem is, in most scenarios, this doesn't actually work out to beat the dollar cost average example. The reason for that is because when we go back up to this example, a lot of the time, you'll actually have to wait a long time. The stock market will go up a lot before you can buy again, right? So let's say you buy the perfect time here and you saved all this cash. Well, the smart thing to do would be to continue buying right here, because it's just going up and up and up from here. So the next time you buy is actually up here, when you could have been buying all this time below. But that's the next dip. Even if you buy perfectly between two all-time highs, it's not necessarily always going to beat the market. And you also miss out on dividends. A lot of the time, these index funds will pay dividends. Now, this is specific to index funds, but a lot of the time, the buy the dip underperforms, and usually it outperforms when there's a drastic drop in the market, and that makes sense, right? If you're buying, and then all of a sudden the market falls 40% in a day, like some massive crash, or let's say 40% a month, then you're going to underperform. But right now, this is typically a good time to be dollar cost averaging, because we have fallen a drastic amount or a good amount. This is the worst start to the year. So this would be when a lot of people would say, now's the time to be deploying cash. Also, it's just really hard to time the bottom. We don't really know, because a lot of the time the markets return before all the macro uncertainty is gone. So we build that in, we price that in earlier, and a lot of us are emotional at the bottom as well. And they said one of the reasons that it actually underperforms too is because while you wait for the next dip, the market is likely going to keep rising and leave you behind. I think about it as an escalator, where you can fight against the escalator for a short period of time and win. But if you just go down, or you try to run against the escalator for, an hour, you're going to lose, or, a day or a month, right? Same thing with the market. You can fight against the market for a short period of time, but over the long term, over 5, 10, 20 years, it's really hard to fight that. Also, they said too, if you miss the bottom by just 2 months, this leads to underperforming dollar cost averaging 97% of the time. So you have to get within a very tight window and time it perfectly to beat dollar cost averaging. Now, of course, I'm not a financial advisor. I can't see what's going to happen in the future, but I just know that I'm going to be emotional, right? Whether it's for the good or the bad, whether I am excited or whether I am worried, I know that I am not a perfect investor, so I just continue to dollar cost average, and no matter what the market's looking like, I just continue to pile money in. Now let me know your thoughts on this underneath the video. Let me know if this is something that you're doing, or if you're just having a lump sum. Now, of course, you do have to have some cash on the sidelines just for emergencies and expenses and stuff like that, but that is separate in my opinion. Now let me know your thoughts though. Thank you so much for watching. Hit the like and subscribe, and I'll see you in the next one. Bye.